Good afternoon, everyone. I'm Pamela Hastings, Relationship Manager at Barometer Capital, and welcome to another Tuesday afternoon webcast. This is going to be the last broadcast until after Labor Day. We're wrapping up the summer season. We're heading into Labor Day. It's probably one of the quietest weeks heading into September, which is in many regards like a new year for people. So, we're just pleased that you were able to join us this summer. And during this conversation, we are going to hear from David Burrows, our Chief Investment Strategist and President at Barometer. As well, we've asked one of our key analysts, Amit Joshi, to join us, who will speak to us on some of the themes that we are investing in right now. Amit's eyes and ears on the trading desk, so we're lucky to have him joining us this afternoon. We're going to keep this conversation brief, but as always, we're happy to have and address any of the questions that you have, so don't be shy. You can email me at phastings@barometercapital.ca or hit me up on the chat with your questions. And with that, for a macro overview, I turn the conversation over to David Burrows. Good afternoon, David. Happy almost end of August.
I can't believe it. When we came into May and things were, starting to open up a little bit, it seemed like the summer was stretching out in front of us forever. And here we are coming into Labor Day. I don't know.
Little did we know that this is actually our second summer of doing this. Yeah. Lori Ouellette, our relationship manager, one of our relationship managers, had this amazing idea to broadcast out to our investors and prospective investors. And here we are, second season.
Amazing. So. It is amazing. I'll tell you what's more amazing is it's the week before Labor Day and all of my kids can't wait to get to school. They've all taken off and headed down to university early. And I think everybody's looking for a little bit of a normal year versus last year. So lots to talk about today. We'll move quickly. I've asked Amit to join us to talk about a few of the key ideas on one of our themes. But I just wanted to take a look at the world sort of through our lenses as we always do. As most of you know, we believe we're in a structural bull market that started in 2013 when we exceeded the highs from 2000. And since then, it's been kind of 4 steps forward, 1 step back. There have been some big steps back. 2015-16 was kind of choppy. Certainly 2018, the end of the year was a major chop. And of course, going into the pandemic. However, market conditions, I think, have confounded a lot of folks because once you get into a structural bull market, it goes on way longer than people think. This is 1981 through 2000. This is 1951 through 1966. And of course, we've been at this now since 2013. In the Dow and the S&P, NASDAQ joined in and made a new high in 2016. And has been working its way ever higher since. We also have been making a case that we've been going through a structural bottoming in interest rates. It looks as though the bottom of the pandemic panic was the low in the 10-year in and around 50 basis points and had been declining for a long period of time. So we are looking at what works well during a rising rate environment or a reflationary period. And we also make the case that it's likely that we saw a generational or secular bottoming in commodity prices around the same time, and things have been improving since then. So lots of areas to look at in the market, lots of areas outside of really the most popular area of the market for the last several years, which has been technology. And we just continue to plumb on whether, in fact, this is a broadening market with broader and broader participation, which is healthy, or whether it is, in fact, just a narrow market focused on just a couple of sectors. So just to touch on a high level in the S&P, we've been putting this chart up weekly since the end of October in 2020, and we're now almost a year within this channel. And it has confounded all kinds of people because not only have we been fighting COVID all the way through this period and supply chain issues and employment issues, we've been fighting, global shortages in supplies, but the market has continued to work its way higher. We've worried along the way that we would see some Fed tightening. Of course, last week we had the speech from Jackson Hole, lots of concern about what the Fed might have to say, and Powell on tapering and potential rising rates. It was sort of a non-event. We've seen Delta virus cases rising. it's been sort of a non-event. There have been things going on inside the market, but the market has been remarkably sound, and we have climbed this wall of worry now for over a year. We made a case early in the year. It was likely we could have quite a low volatility period going forward as people slowly redeployed and moved money from other asset classes. That appears to be the case, but we continue to ask the question, can this continue? When we look at the NASDAQ 100, NASDAQ 100 did have quite a consolidation of about 113 days in the period from sort of February through mid-June, and did underperform for a significant period of time. A lot of the big name tech stocks took a breath. And in the meantime, reflationary sectors, were leading the market sort of from October until June. And then in June, we had a breath from some of the more reflationary sectors, and the NASDAQ reaccelerated. So the question is, which one is the leadership, or are they both? I think it's interesting that when we look at the S&P equally weighted index, taking out the impact of the largest cap stocks, we know that when we got some consolidation from May through July in reflation, the average stock consolidated and corrected. And since middle of July, the equally weighted S&P reaccelerated, which really means the average stock reaccelerated. It means both tech and reflation have been improving, and we've had a broadening market. When we look at the Canadian market has also been remarkably sound. In fact, performing well relative to the S&P 500 over the last few months after many years of underperformance. That has something to do with the makeup of the index and the weightings and things like industrials and financials. But nice to see the Canadian market participating alongside. So let's just revisit quickly the themes that we've been focused on over the last little while. Take a look at sort of the progress. We know that last week there was lots of concern around Jackson Hole, and we know that there have been lots of things to think about with the Delta variant. So what kind of impact has that had? I always like to say it's not the news that matters, it's the way the market reacts to the news, which is why I think it's so important to have tools to measure what is happening internally in the market. Is breadth expanding, meaning it's a healthy market, or is breadth deteriorating? So let's just take a look at that. The US dollar has been a key linchpin since the beginning of the rally. Think of the US dollar as a safe haven asset that people go to when they don't want to have risk in their portfolio. So dollar tends to rally in a crisis. And then as people become more confident, they slowly will take those dollars and deploy them into riskier assets, hoping to get a better return. And we know that the dollar peaked out at the end of March last year and has been making lower highs since then. We certainly went into a consolidation sort of at the end of last year. And you can see we dipped, rallied back, tried to rally, failed, dipped again, tried to rally again. And just to point out, as we got back into this sort of resistance area, the strength of the rally started to wane, because you can see on this thrust, you had a move in momentum. When you had the next thrust, much lower momentum, and that appears to be failing. So that would say it's possible that money was moving back toward riskier assets. Now, we've had through the period of the summer this concern around the Delta variant. So, what can we take away from that? Well, certainly as the US dollar started to back off, some of the more risk-oriented assets or things that have a more negative correlation to the US dollar started to accelerate. Without spending a lot of time on it, one of the topics that has come up over the past week is what's happening in the world of crypto, because Ethereum, of course, had a huge run into the spring and then consolidated through the summer. Rallying as the US dollar strengthened, crypto traded sideways, and then Ethereum is broken out to the upside. So I think that may be a tell for other risk assets, but we'll talk about that as we go along. The TLT is the US long-term treasury bond ETF. So the long-term bonds sort of had their short-term peak in March of 2020, and we've been making lower highs since then on successive rally attempts. And again, we rallied in July. We made a lower high at the end of July. We made a lower high here in August. really losing momentum. So my guess was that this was more of a correction of this initial move lower in bond prices or move higher in yield. We got less than a 50% retracement of that rally, and it appears to have run out of gas. So again, points to more risk-oriented assets taking leadership. So let's look at some of the key themes. Financials would be the most important theme that benefits from rising rates or a stronger economy. This is the IAI ETF, which is made up of investment managers and capital markets. We talked over the last few weeks about Goldman Sachs. We've talked about Morgan Stanley being a major holding of ours. We've talked about CI Financial and IGM investment managers. Obviously, these are companies that all benefit from stronger economies, stronger markets. And we just recently, yesterday, made a new high in the IAI and actually had a relative strength high versus the market. This is the insurance sector. You're going to see a lot of this. We've talked about this over the last few weeks. A lot of these reflationary themes corrected and consolidated, broke out, retested that breakout, and moved on to higher highs. So financials continuing to act particularly well. We've talked about Canadian banks like Royal and Commerce and some of the insurance companies, of course, some of the US banks also behaving really well. Materials, same picture, consolidated, broke out, retested about a week ago, and now moving back toward highs. And that includes, of course, the metals companies, some of the energy spaces, and I've highlighted this week, the uranium group that had really corrected back to the long-term moving average, turned and is headed north. Companies like Cameco, which would fit in that camp. Also, the lithium companies and battery technology companies in that area. In the industrials had the exact same picture, corrected sort of from the beginning of May, broke out, retested, and turning higher, led higher by robotics and automation. In Canada, we own ATS Automation, which has really had a nice turn for the better. And again, after a long consolidation breaking out to the upside, these are groups that are certainly tied to capital investment in the real world and certainly are reflationary. And also tied to this theme is the idea that we want to own dividend growth-oriented securities in a period where rates may be headed higher. And after consolidating, the dividend growth ETF RDVY has recently made a new high over the last 2 days. And again, looks like it's kicking off a next leg higher. So all in all, after consolidating over several weeks, those momentum areas of the market looks like they have reaccelerated. When we talked last week about our exposures, we highlighted that we have big weightings in financials and industrials, materials, but also that we still have quite a significant weight in technology. Now, we mentioned that we were underweight technology versus the market, but we had been raising our weight. And the reason that I say that is that while the tech group consolidated, some of the largest stocks took off, while the average stock in the sector didn't. When we looked at the IYW, which is made up of a broad base of large cap technology companies, it's had a great 2 weeks after languishing for about 3 weeks. And I highlight that when we look at breadth for the NASDAQ, in February, 72% of all the stocks in the NASDAQ were in uptrends. And the breadth narrowed and narrowed and narrowed until we got to the point where 42% of stocks in the NASDAQ were in uptrends, less than 50%. And this is where we sit today. But some of the very large cap stocks have continued to act well. We held those large cap names, and they include companies in the semiconductor sector, which actually just today made, yesterday made new all-time highs, and the cybersecurity area. But individual names that we focused in order of size in our weightings, this would be, I think, the third biggest position in the firm. Microsoft at about a $25 million position. Apple is about a $20 million position. Google is about an $18 million position. Facebook is about a $15 million position. NVIDIA about a $12 million position. All of these acting extremely well. Cisco would be about a $12 million position. but all very large cap names. What I've asked today is for Amit to join us. You guys know these names and you know their areas of focus and why it is they've done so well. I wanted to talk a little bit about some of the smaller up and coming companies that we have in the area of technology, because they continue to perform really well. So Amit, maybe you could start with Lightspeed, which is probably one of the biggest Canadian technology companies that people may or may not know well. Talk a little bit about that, and then we can talk about a couple of smaller ones.
Sure. Thanks, Dave. Thanks for having me. So yeah, just to kick it off on Lightspeed, it is a name that we've held in portfolios for a while and one that's probably well known to investors compared to the other names that we're going to speak about today. The company itself is a cloud-based point of sale system. It's predominantly been a brick and mortar play, and in the early stages of the pandemic, tilted to add on e-commerce and payment processing capabilities. So very strategic move by the company at that point. Recently, the company's changed its name from Lightspeed POS to Lightspeed Commerce. So that kind of reaffirms the company's motives to build out a one-stop commerce platform for customers globally. We expect M&A to become a bigger part of the story going forward. So they'll grow more through acquisitions and continue to grow organically as well, through the addition of e-commerce and payment processing capabilities, as well as their legacy point of sale business.
So Amit, let me jump in for a second.
Sure.
So when we talk about point of sale, we think about those machines that we use when you go into a retail store, into a restaurant.
That's right.
A card. Lightspeed has taken it obviously a lot further than that. Can you just explain sort of what their suite of products might do for a retailer or for a restaurant?
Definitely. First of all, Lightspeed's product, their point of sale system is in the cloud, so it's cloud-based, and it also adds on capabilities in terms of reporting and analytics that can be provided to the customers themselves. And they've also now layered in e-commerce, so these customers can, other than just using their brick and mortars, can conduct commerce over the internet. And payment processing has become a big part of the game plan going forward for the company as well. Another addition that's been really interesting to their business offering is Lightspeed Capital. So the ability to provide their customers with short-term loans. And it's pretty interesting because Lightspeed, being the point of sale provider for these companies, has the insights in terms of revenue trends and in terms of bookings and everything else. So very interesting from that standpoint. Like I mentioned, we expect acquisitions to become a bigger part of the story going forward. And the company has shown a strong history of doing a great job of integrating very strategic acquisitions. They recently reported very strong quarter earlier in the month on the back of reopening of economies, and at that time also provided longer term targets of margins reaching 20% and significant revenue growth, which will be driven not only by the point of sale business, but also from the new financial products as well as payment processing. So very interesting company at this point.
So that's excellent. So from my standpoint, this is one of those companies that had a great run and then needed to consolidate. And so a lot of technology consolidated kind of from January through into June. And then of course, look at the relative strength versus the market really started to lift. And this has been a real leader in the Canadian marketplace. Let's jump to a smaller company, Amit. Again, these are companies that we hold in client portfolios. Talk a little bit about Nuvei, because Nuvei is maybe a new name to a lot of investors.
Yeah, definitely. Nuvei is a very interesting company. They just IPO'd last year. Nuvei is an electronic payment processing company, so they provide their clients with an entire suite of payment capabilities, and they're a bit different compared to some of their peers as they focus on higher growth, higher margin verticals, and some of those include regulated online gaming and social gaming, e-commerce, and they also have capabilities settling cryptocurrency transactions without taking any cryptocurrency risks. So what they kind of look in terms of the verticals that they play in are three common criteria of strong growth, secular longevity in terms of that growth, and then the ability to operate globally, which has been very interesting for the company. They recently reported a blowout Q2 earnings report and then also introduced some medium-term guidance. Management expects revenues to grow at about 30% and feel EBITDA margins can get up to 50% in the long term. So very strong medium-term guidance provided by the company. And I'd say what differentiates this company from their peers is the flexibility and customization that Nuvei can offer their clients, which has been something that the clients have really appreciated and has helped them win a lot of business.
Technically, when I look at this, I always love to see a company that reports a blowout quarter, has a breakaway gap, leaves it behind, and really shows no sign of revisiting it. That really shows internal strength in the share price. And of course, this is a company that is not well owned across the Canadian universe. It's a $10 billion market cap. It's a big company, but this is one that is still in relatively early stages. Let's jump from Nuvei to Converge Technologies. Again, we have some folks that have this in their portfolio at $3, and we're pushing on 12. Maybe talk a little bit about Converge.
Sure, yeah. Converge is an idea we've been very excited about. And like you mentioned, we started adding to earlier last year, or late last year, sorry. Converge itself is an IT cloud solutions provider. So they provide IT infrastructure for companies that are trying to get into the cloud. So based in the start of the pandemic, obviously something that was very highlighted as more and more people were working from home. So it plays really well into the cloud computing theme. In terms of the addressable market globally, it's about a $3.7 trillion market. So Converge plays in a very small portion of that in terms of their focus being small and medium-sized businesses, as well as mid-market and enterprise, which would still be about a $1 trillion market. So it's very fragmented, and Converge has been growing both organically and through M&A by acquiring companies through North America.
So can you just explain, Amit, what they basically are doing? They are taking various types of technology solutions and integrating them together and providing an infrastructure to run the business on a technology platform. Is that right?
That's exactly right. Yeah. So they have strong vendor relationships with the likes of IBM, Red Hat, Dell Technologies, VMware, companies that would be very well known to investors. And on the cloud side, they also partner with the likes of Microsoft Azure, Amazon Web Services, and Google Cloud. So essentially, they'd be helping companies get their infrastructure into the cloud and optimize those solutions and deal with numerous vendors to get that solution ready for their clients. So there's been a huge need, especially in the back of the pandemic, for this, and still very early stages in terms of global adoption of cloud computing.
So I noticed that the 2022 estimate is a 140% increase in earnings. What kind of revenue and revenue growth can we expect from these guys?
Yeah, so the company recently held their annual general meeting in late June and provided some targets. And the 2025 revenue guidance is for about $5 billion, which is kind of a double from where we are now. And in terms of EBITDA, it'd be a double as well. So there's a long runway of growth here, and it's predominantly been through acquisition. The company's acquired over 23 companies since 2017, and that's helped them grow their footprint in North America. And recently, they announced an acquisition in Europe and UK of RedNet, which will help be a platform acquisition for them to grow in Europe as well. So just kind of early innings for growth in Europe itself. We'll continue to add on to that platform, but we'll continue to also grow through acquisitions in North America with more tuck-in size nature of acquisitions.
So that's great, Emmett. I really appreciate it, because we spend a lot of time talking about some of the biggest companies we're focused in, and they're companies that just continue to give. But it is the case that there are lots of really interesting newer companies that are finding niches within these big themes like cloud and payments companies.
Yeah.
That are developing into nice big businesses. And they could continue to grow for really, really long time. So thanks so much for jumping on these. I look at last week, and last week market was sort of dominated by more reflationary themes, but technology continues to chug along, and there's been some great returns from some of these areas. So I just wanted to highlight, what the way we look at things here. When I look at August 20th, if I took all of the major sectors and put them on a distribution curve to say, for each sector, what percent of stocks were in long-term advances? we, in capital letters, we put each of the sectors that are showing an expansion in breadth. And in small letters are the sectors that were showing some deterioration. So we had some softness in some of our indicators early in August. And you can see that many sectors had shown some deterioration and were causing us some concern. Now, what happens is when we see deterioration in breadth, we don't go sell everything because it may be a short-term issue. We stop putting on new positions in those groups. And we put stop losses underneath existing positions such that if they were to pull back to a point where our risk reward levels change, we make sure that a little mistake doesn't turn into a big mistake. Now, when we fast forward here to today, and you look at the sector chart, you can see, and you can eyeball it, there's about 10 sectors that were showing expanding breadth on the 20th. Today, like 21 or 22 sectors are in capital letters showing expanding breadth. And that gives us guidance as to where we might want to be adding new positions. So sectors that turned higher are things like transports and semiconductors and computers. But certainly, you know, banks maintained their strength all the way through, as did the savings and loans, which are more regional banks, builders, waste management, insurance, and so on. So what I take away is that while we've had lots of news and disappointment for the Americans as to how things ended in Afghanistan, concerns around a Delta variant, the Jackson Hole comments last week from the Fed, what I can tell you is that's the news. The way the market's reacting to the news is the strength is broadening. And I think that that's really important to take away. When we look at our breadth models, the US large cap breadth model is expanding. Our short-term indicators, percent of stocks with the 50-day moving average moving higher, percent of stocks with positive weekly momentum moving higher, percent of stocks trading above their 150-day moving average moving higher. It's an improving picture. It's a strengthening market. When we look around the world, you can note all Europe showing expanding breadth, all Middle East showing expanding breadth, all Latin America showing expanding breadth. These have all reversed up in the last 2 weeks. All US showing expanding breadth. Importantly, China showing improvement after some weak markets over the last few weeks, in India. South Korea also. So weaker US dollar tends to be better for global markets. We know that India has really sort of taken off over the last 2 weeks. That's really important. Mexico is an important trading partner in North America. After breaking out and consolidating, this is a multi-year trading range it had been in, turning higher and breaking out today to a new all-time high. This is the EWW ETF. And when we look at what's happening in Taiwan, this is the long-term chart of that EWW. And then when we look at Taiwan, we have a similar picture, consolidated for about 130 days. And today closing virtually at a new all-time high. So important to see breadth expanding at the sector level, important to see breadth expanding at the global market level. The equity asset class is seeing expanding breadth. So expanding breadth in commodities and basic materials, expanding breadth in equities, weakness across fixed income. Relative of all of the 6,000 ETFs that I track, 288 ETFs made new relative lows versus the S&P yesterday. About 260 of those were fixed income ETFs. So money clearly is moving from the fixed income asset class to things like basic materials and things like equities. So some basic data points from this week. We talked about how easy financial conditions have been. The old saying, don't fight the Fed. And post the Jackson Hole comments, market continues to read it that way. We've talked about the exceedingly low inventories in the system. And everywhere we hear there is a shortage of supply in the manufacturing process, which means that not only do we have some expanding demand, but there's going to be a catch up of several quarters as companies rebuild their inventories level back up, which will be a solid source of demand. We've talked about an improving jobs picture, and we're going to get more jobs data this week, but unemployment claims still clearly elevated from prior to the pandemic. And of course, we talk about Delta. This is Canada, and this is the number of tests completed and the percent that have been positive. That's rising. That's something to think about. However, what we think is more important is that the R factor, or the reproduction number, as it moves back down towards 1, means that cases will start to slow going forward. Now that's Canada. Let's talk about the US. And I think this is really important. This is the R factor in Florida, which has now moved solidly below 1. The same thing has happened in Texas. So some of those states that we worry about are seeing an improvement in this picture. And I think that the market is sniffing this out, which is why more economically sensitive sectors are acting a little bit better over the last couple of weeks. And that could mean that we could have a solid sort of back half of the year. Also, borne out in the volatility readings, which as of today, were basically about the lowest they've been in the last 18 months. So got 3 basic jobs. Number 1 job is identify market leadership and focus in those areas. We're always watching for change. Where we see improvement, we want to look to be adding. And so we want to always look at the evidence to say, is there new strength in new areas of the market that we should be participating in? Because we'd rather not just focus in 2 or 3 sectors. We'd like to have a broad-based, diversified portfolio if possible. And in the absence of leadership, have an ability to be on the sidelines. So we always look at our weightings on a week-to-week basis. Financials remain our most important sector, but you can see technology is again creeping higher. We're seeing improvement in the technology space. Industrials continues to be a big overweight for us. Real estate is an overweight. And then really the other big overweight would be materials at basically a double weight of the index, and significant underweights in things like consumer discretionary and healthcare and consumer services, communication services. So I know there's things to worry about, but we need a wall of worry for the market to climb. The fact that we are seeing low volatility is healthy. The fact that we had a sentiment reset in the market over the last few weeks, where bearishness picked up and bullishness retreated, doesn't matter that there wasn't a significant pullback. There's a sentiment reset. If breadth starts to wane, or some of these themes start to lose their steam, we're very happy to raise cash and go to the sidelines. But in the meantime, you got to remember the adage: the hardest thing to do in a bull market is to stay in your winning positions. The hardest thing to do in a bear market is to be a good seller. And right now it's time for holding. So looking forward to getting out of the summer doldrums of August and into September when people come back to work. But Pam, if there's any questions, certainly happy to answer them.
Thanks so much, Dave. We just have one question so far, and that's about the Canadian banks. I know that we have a holding in a few of the Canadian banks. If you could just walk our investors through our largest holdings and where you think the Canadian dollar is going from here as well.
Sure. So the second biggest holding in the firm is Royal Bank. We have a $43 million position. We have a $32 million position in National Bank, and we got a $30 million position in BMO. The reason that we own these is we think that the Canadian economy is set to perform well in the sectors that are kind of leading. The Canadian banks have an excellent dividend record and relatively low volatility. They all have pretty good wealth management businesses, which are performing well. And we've got a sector backdrop for financials as a whole that's very supportive. So, we do have good weighting. We also have a good size weighting in the large insurance companies. Great West is a significant weight for the firm. And then, of course, in asset management, CI and IGM. So I think that if we are into a reflationary environment where the yield curve generally steepens, meaning the long-term rates rise a little bit more than the short-term rates, and that's what we have been seeing, that's a very productive time to own financials. And while in Canada, financials are well loved, outside of Canada, they really aren't. The US Bank Index made its first new high this year since 2008. And certainly Europe is actually not close to making new highs. So it's a generally under-owned sector globally.
Dave, any concerns on the potential increase on the tax rate for banks? Is there any materiality there? And are we thinking about that in our thesis and owning those?
Look, you have to think about and worry about everything. The ratings agencies shot a shot across the bow by saying that if the taxes were to be raised on profits on the banks, in other words, targeting the banks, that would be seen as a negative for Canada credit. So I don't think that that's an overly likely outcome, but we have to continue to consider it as a possibility.
Well, that concludes our questions for today, David. And thank you so much, Amit, for joining us as always. We always appreciate hearing your thoughts and views. With that, Dave, we're heading into the long weekend. So I want to wish you and all of our investors a very happy Labor Day. And Dave, as always, I leave you with the final word.
Look, we appreciate the fact that we've had so many people logged on to these calls every week. We're going to continue to do them. Hopefully, we'll continue to keep them interesting. I don't want to jinx the fact that the market's been in this great glide path, and we worry every day that it's going to come to an end. But I would say that in general, the conditions continue to improve. Let's make sure we're looking forward, not backwards. So let's look at what will work in an improving new business cycle. Because it looks like that's the direction we're going in, and not get caught up in the fact that the market, continues to make new highs, because new highs in a bull market beget more new highs. And there's a lot of money that's sitting on the sidelines in money market. There's a lot of money, a ton of money, a mountain of money that is tied up in the bond market. Neither of those are providing any return to investors. And we think that a lot of that money can slowly drip into some of these asset classes that will do better in a reflationary environment. So thanks everyone for tuning in. Amit, thanks for jumping on the call today. Thanks, Pam.